Good morning, everybody. Welcome to today's webinar. My name is Jane Stevens. I'm the training manager here at Zolo, and I am joined today by REALTYTAX.CA. So welcome, Steven and Neal. Thank you for joining me today.
Hello.
Hello, hello. So we still have people coming in, joining us. So I know this is a hot topic. It is tax time. So I know that there will be lots of questions. Guys, they've prepared a presentation for us. So we're going to keep questions to the end, but do feel free to post your questions in the chat as the questions come up so that we can address them at the end. So again, thank you so much, guys, for joining me. For those of you who can see the screen, hopefully you can, REALTYTAX.CA, definitely check out the website. I checked it out before starting the webinar, and it's amazing. There's a ton of information that will also be shared with you right now. So thanks again, Steven and Neal. Welcome, and take it away.
Perfect. Thanks, Jane, for the introduction. And also for those who know Ronnie Kamenetsky, you can also thank him for coordinating and getting this contact together as well. So thank you to all of you. And thank you all for joining us this morning on a gray morning in Toronto. I don't know if how many of you are in Toronto, but it's very gray and wintry here. So I'll just start it off. My name is Stephen Pettucci. Joining me today is Neal Winokur. And we are both the co-founders of REALTYTAX.CA, which is our slogan being the all-in-one tax solution for Ontario realtors. So who are we, right? I mean, two new faces. What do we do? How much experience do we have? So I'll go right into it. So we are both chartered professional accountants, and we have too many years of experience serving small business owners. Not that we feel bad about that, it's just to say we've been doing this for quite a while. I started my practice back in 2018, and before that, I actually had 5 years experience working in other firms as a CPA. And what's interesting about my practice is that I've been focused on getting business owners basically on cloud accounting technology while still ensuring that they meet compliance requirements and all that kind of stuff. So I've been doing that for quite some time. And with Neal, he's actually had even more experience than me. He started his firm back in 2013, and he's passionate about helping clients minimize taxes and always forces them to file on time and avoid penalties. So he's always looking out for you in your interests. And also what's interesting about Neal is that he published a book. So not only is he an accountant, but he's also a scholar. So he published a book called The Grumpy Accountant. And this book exposes the insanity of our tax system and offers ideas on how to massively simplify it once and for all. The link to his book is actually at the is on the slide, and it's available for purchase on Amazon.ca. Okay, so just going to start off with a quick disclaimer. Of course, any information you take away from this, always try to consult an advisor before making a decision. We try to make this as elaborate as possible, but this just technically does not serve as legal, tax, or financial guidance. So just want to put that out there. Okay, so let's start with understanding what is a personal real estate corporation. This is something that since I'll call it early October, both the Real Estate Council of Ontario, Ontario Real Estate Association, TREB, they've all been sending emails out talking about this personal real estate corp. They've been trying to push people to open these personal real estate corps. And if you're a realtor who may not understand corporations or corporate taxes or all that kind of stuff, you may be kind of puzzled and wondering, okay, should I really be making a decision, or should I just maybe hold back? The interesting thing about personal real estate corporations is that it's something that has been lobbied for years. I think it was back in 2008 or 2009, even around that period where realtors started lobbying to get this law passed. And luckily, after over a decade of lobbying, they finally changed the law. So now they basically added regulations to REBA 2002, which is the law that governs how realtors, basically it's a law that basically says how realtors should adhere to. It basically now allows realtors to incorporate a personal real estate corporation. So this is brand new law. It came into effect October 1st. From the legality of it, a personal real estate corporation is seen by federal and Ontario law as an active business. So just as, let's say, you may have another numbered corporation that, let's say, for example, sells t-shirts on weekends or whatever, that the actual formulation of that corporation is technically the same, but it's technically not a professional corporation. So this is sometimes something where a lot of people get confused with. They think, oh, okay, because I'm setting up a PREC, this means it's now a professional corp. The professional corporation, that's something that's designated for lawyers, accountants, doctors, like technically Realty Tax is a professional corporation, but the PREC is not. So just something to keep in mind when you're, when you're looking through this terminology. The more important thing, though, is that nothing changes in the way that realtors operate or advertise their services when they have a PREC. So there's something very important to note with this, because in different provinces, the regulations for PRECs actually differ. So if you have any realtor friends that are in British Columbia, you may see that on their advertisements, they have like their name dash PREC. Well, in Ontario, they actually say that you cannot advertise that name PREC in anything that you do. So for you, it's great, because if you already have business cards set out without the name PREC, you don't have to make an investment into getting new business cards. You simply continue to operate as you do currently. But the important thing too is that you must have a new agreement with your brokerage, which I will discuss later. So what are the three main reasons why realtors should consider setting up a PREC? And for those who are familiar and have been reading about it, the first thing that probably comes up is, oh, so I can save on taxes. Well, yes, that's technically one of the things. One of the things that's a benefit of having a PREC is that, I guess someone's microwave's going there. One of the benefits of a PREC is tax deferral. So basically, it allows you to pay taxes later. And I'll explain what that basically means. But the way how you can consider going into this thinking about, can I get tax deferral? It generally applies when realtors' net income, so this is their commission income less their expenses, is greater than their living expenses. So what I mean by living expenses is it's basically, if you had a corporation, how much would you need to draw out of it on a yearly basis to pay for your living expenses, travel, leisure, anything personal? So if you're making a ton of income right now and your expenses are a lot lower than that, then tax deferral will definitely be an advantage to you. And when I'm saying tax deferral, at the same time, there's also direct tax savings that can happen in the long term. So I'm not trying to be crafty and saying you won't save on taxes. No, I mean, in theory, you could actually also save in taxes on the long term, depending on how much income you're making, the amount of draws you'll need, and so forth. So the second reason why realtors should consider setting up PREC, where this is where also the tax savings come in, is that you can income split with adult family members. So we'll talk a bit about that in more detail. And thirdly being, you get the legal protection of assets when you have not just a PREC, but a corporation in general. So again, we'll discuss that in more detail. So now I'll have Neil take it away to discuss what we mean by tax deferral.
Okay, so to explain the tax deferral, I'm going to run through just a couple very short examples. It won't be number heavy, so we don't want to confuse people, but this will just show you the basic idea here. So in the corporation, in your personal real estate corporation, the tax rate is only 12.2%. That's combined federal plus Ontario tax rate, okay? It varies across the country, but these numbers will just be Ontario. It varies a little bit in different provinces. So 12.2% is the tax rate on the profit, the first $500,000 of profit. Anything above $500,000 is taxed at 26%, but the 12.2% is where you really get the advantage. Because if you look at the personal tax rates, the top rate in Ontario is 53.4%. That kicks in around 216,000 of income ish, approximately. And even if your income is above 150,000 personally, you're paying about 48% on all income between 150 and 200. So you can see the difference between 12.2% and 48%. But here's how the corporation works. Every dollar that you withdraw from the corporation, that will become your salary or a dividend, and we'll talk a bit more about that. And that must be shown on your personal tax return. We prepare a T4 for salary or T5 for dividend, and you pay personal income tax on the withdrawal. So the general rule of thumb here basically is you want to try and show as little personal income as possible and leave as much money as possible in the corporation. And this is really the problem in Canada with our federal government's financial situation constantly running budget deficits, and no one can figure out, why are we always running a deficit? Why can't we balance the budget? Well, they've made the personal tax rate so high and the corporate tax rate so low. So every small business owner in the country is desperately trying to leave as much money as possible in their small business corporation and only take out into personal income what they need to live off of to fund their personal living. So the Prac will provide this flexibility because every year you get to decide how much money to take out from the Prac and show in personal income. You could choose to take out zero, or you could choose to take out 100,000 or 200,000 or anything in between. And that gives you really nice flexibility. It allows you to avoid the highest personal tax brackets every year.
Perfect.
So yeah, let's keep going here. So in this example, imagine an agent who earns about $75,000, okay, of profit from commission income. So that's $75,000 of profit. Right now, if you don't have a Prac, if you don't have the corporation set up, that's personal income on your personal tax return, right? And your total tax bill, including CPP, will be about $21,000. That's about $15,000 of income tax and almost $6,000 of CPP, kind of the pension plan. So that's if you don't have the personal real estate corporation. Now, one way you could save money is actually doing a dividend instead of a salary. Dividend is when the corporation pays you as a shareholder an amount that you decide, and it allows you to avoid paying into CPP, the Canada Pension Plan. And that would save you a bit of money here. It's showing in the numbers that I ran, it shows you about $3,000 in that specific case. Okay, but let's keep going, Steve. Yeah, because there's pros and cons here. Salary versus dividend. This is a big issue for every small business owner in Canada. You get to decide how you want to withdraw money from your corporation. So there's pros and cons of each choice. When you do salary, you're forced to pay into Canada Pension Plan. Just like now, you're all paying into Canada Pension Plan based on your self-employment income from your commissions. Some people actually like CPP. Because it's indexed to inflation and it is fully funded. It's not like in the United States, their social security is basically unfunded. In Canada, CPP is a fund that's managed separately from the government finances. At least now it is, and we hope it stays that way. So it's separate and it's fully funded. Also, when you pay a salary, you create RRSP contribution room, which for those agents with the higher income is really beneficial to be contributing to your RRSP, even if you have a personal real estate corporation. And we can get more into that as well. Now, some people who are self-employed, they don't want to pay into CPP. They don't care about RSPs. And they don't like paying double CPP, right? Because right now you're all paying the employee and the employer portion. That would be the same with the corporation. That doesn't change. So some people don't like that, and they'd rather pay a dividend and avoid CPP altogether. So those people, at least now you have a choice where you can pay a dividend instead of a salary. Let's keep going here. So here's another example for a higher income agent. This is where you really start to see the value of the tax savings. So let's say you have $300,000 of profit, okay? But you don't need $300,000 to live off of. Hopefully you don't, because that's an expensive budget for personal use. So hopefully,
Unless if you live on an island or something.
Yeah, maybe you're, who knows? But
or you may live in Toronto.
yeah, that's true. Yeah, if you live in the GTA or in Vancouver. But let's say your profit in the Prac is $300,000, but you don't need that much. You only need $100,000. Okay, so without a Prac, right now, your $300,000 of profit, it's all personal income. You don't have a choice. There's little things you could do to bring it down. You make a RSP contribution, maybe you have donation receipts, but for the most part, you're stuck with that personal income, and you have this huge tax bill of it's about 128,000 there. Okay, these are the rates for Ontario, combined federal Ontario. Now with a Prac, what you can do is you only pay yourself $100,000 out of the corporation. That's what you need to live off of. You have to pay it. So you take that salary, you pay the personal income tax, you pay the CPP on your salary, but your corporate income tax is a lot lower. Your overall tax is so much lower because that extra $200,000 you're leaving in the personal real estate corporation. It's only being taxed at 12.2%. So in this case, your total tax bill is $54,000. And your total tax savings is $74,000. That's in 1 year. That's 1 year. So those savings will repeat every year if your income, if your situation is the same every year. So you could see how quickly that adds up. And what you can do with that extra cash that builds up in your personal real estate corporation is you can now invest it. So you now have more after-tax money within the corporation to invest. Okay, so let's keep going here. Right, so this is what I was just saying. What do you do with the money? Oh, okay, so I just want to address Lex's question in the chat. Because what she's saying is 12.2% times 300,000. No, because the 100,000 salary is a deductible expense in the corporation. So the net income in the corporation becomes 300,000 minus the $100,000 salary. That's an expense. You don't pay double tax on your salary. Okay. So the corporate profit now becomes 200,000. That's why it's 12.2% times 200,000. And the 100,000 is taxed personally. Dividend tax of niche, we'll get to that later because that's a bit more complicated, because the dividend is not an expense in the corporation. It's taxed personally. Overall, whether you do salary or dividend, the overall income tax basically is the same. And the system is designed like that. They call it integration. The Canadian tax system has integration, meaning whether you do salary or dividend, you're basically going to pay the same amount of income tax. The difference really is CPP and RRSP. And there are some other differences, but income tax, it basically comes out to the same. So the tax savings that accumulates inside your personal real estate corporation, you can now invest it. You can invest in real estate. You can have a stock portfolio, an investment portfolio like stocks, bonds, GICs, ETFs, mutual funds, right? Investment income will still be taxed each year in the corporation, but you have more money to invest in the first place. So you're still better off from that tax deferral. And the other nice advantage of accumulating the cash in the corporation as it accumulates is you get to decide that flexibility of when you want to withdraw it each year. Some realtors, you have slower years, your income is lower. So maybe in those years you take the withdrawal, right? Or so you have a lot more of that flexibility. Okay, let's keep going here. Steven, did you want to do this slide? Or
Yeah, sure. So
yeah.
basically, as Neil was saying, you can actually use PRECs for investment purposes. And we got to be careful about when I mean investment purposes, because the way how the regulations are stated right now, they're saying that technically the PREC could technically do other activities other than trade in real estate. So as Neil was saying, you could have a PREC that has an investment account to invest in stocks, bonds, GICs, that kind of stuff. The other more, I think, relevant thing even for realtors is that you're advising your clients all the time, oh, buy this property and it will appreciate and you get all these gains and whatever. Well, you too are not just going to sit back and, wait on, or you're just not going to put your sock in your mouth. You're going to be doing the same thing eventually, right? So if you're interested in purchasing real estate in your personal real estate corporation, that is something that you can also do. And while that personal real estate corporation holds those rental properties, it will earn rental income. Now, the thing we just got to keep in mind is you got to be careful on a couple things. So if you do have, let's say, a lot of investments or a lot of savings that's accumulating in your personal real estate corporation, it's typically not advisable to hold a significant amount of what we call the assets of that corporation in the same corp you're operating from. So, and this is more for liability reasons and a whole bunch of other reasons too. So what we say is that if things are really starting to accumulate, you may also want to consider setting up a holding company if you're accumulating a significant amount of assets. And what you can do essentially is you can have the personal real estate corporation transfer money to this, we'll call it like a holding company or shell company, and that would basically separate those assets from your operating company, which is your PREC. Now, a lot of people some people may say, okay, well, Steven, are you sure you want to hold real estate in a corporation? Because, I was reading online, or my accountant said that, it pays it's like a 50% tax rate of passive income that corporations pay on that income. Well, you got to keep in mind is they are correct, but you also need to consider that technically the net income. So basically what your corporation gets taxed on is the net income. So what that basically allows you to do is that for even, let's say for your rental activities, you could declare a salary to yourself to minimize that high corporate tax rate, right? So as Neil was saying, we're doing dividend salaries. That's not really going to change the game as far as how much taxes you're going to save in the long run. But when you're dealing with a 50% rental tax on, we'll call rental income or GICs or interest, or sorry, interest on GICs, I mean, then you could use other strategies to kind of bring that down. So just wanted to put that out there. Neil, do you want to discuss the share structures?
Sure. Yeah. So the regulation says that we have the quote there. This is from the actual regulations. The equity shares of the corporation. Equity means the voting shares. Okay. So the common shares, voting shares, they have to be owned by the controlling shareholder, which has to be a realtor. But it says directly or indirectly, and indirectly means another corporation. So people usually refer to this as a holdco, holding corporation. Holdco is not actually like a legal term. Everyone just uses this term, but it basically means you would own the shares of a holding corporation, and then the holding corporation would own the shares of the personal real estate corporation. And that allows you to move money tax-free from your personal real estate corporation into the holding corporation. And then you could do more investments in the holding corporation in case you don't want to do the investments right in the personal real estate corporation. So like we wouldn't recommend, if someone has a small investment portfolio, that's fine within the personal real estate corporation. It's not a problem. But if someone really is starting to buy like a lot of rental properties, or they have a stock portfolio that's growing into hundreds of thousands of dollars or more, then we would probably recommend setting up this kind of structure, like having this other corporation. And I think on the next slide we show an actual diagram. So there's two different ways to do this. On the left side is the simpler way, where basically, like I said, the realtor owns the shares of the holdco, which owns the shares of the Prac. And the other way is actually you can have the holding corporation own a different class of shares of the personal real estate corporation. And this still allows you to transfer money by way of what's called a dividend, tax-free from the personal real estate corporation to the holding corporation. So it's still considered on the corporate level, and you don't take that personal tax hit. Now, the regulations also state, this is interesting for people who have a spouse who has, let's say, a low level of income, or even a parent or an adult child. So the rule is that non-voting shares of the personal real estate corporation can be owned by a family member. And that could be a spouse or an adult child or even a parent. Now, you have to be very careful here, because in 2017, the federal government introduced a new set of legislation called TOSI. TOSI is tax on split income. It is one of the most complicated, ridiculous, irrational, completely counterintuitive, horrible pieces of legislation ever written. Accountants were really upset. They rammed it through in the summer when accountants take time off to recover from tax season. There was no consultation with the tax experts in the country. It's really poorly written legislation. It's very onerous and punitive. So that will give you an idea of how I feel about it. But basically, you have to stay on side of these rules. Like if you're going to pay a dividend to a spouse, you have to make sure that that spouse is putting in 20 hours a week or more. You have to have proof of that. So we're recommending right now people basically hold off on paying dividends to other family members to avoid this whole mess. But you can still pay salaries. And then the rule for salaries has always been they have to, the employee, if you're saying that your spouse works for your corporation, they actually have to work for your corporation, and the salary that's paid to them has to be reasonable. So it's a similar principle with dividend. But again, I would be careful with this and not try to get around these rules, because they're very punitive and they're very complicated. So for something like this, you have to consult with a very competent tax advisor who can help you with these rules.
Okay, so I'll discuss some of the legal advantages because I was saying in the initial slides, like what are the benefits of PRECs? One of them I said was tax deferral, which we discussed, the income splitting, which we also just discussed right now. And then there's also the actual legal advantages. So we got to keep in mind is that when you have the personal real estate corporation, it doesn't actually limit your exposure to errors and omissions that you could incur as a realtor. The important thing is that your liability doesn't actually change in any way. So, I mean, as far as like your actual insurance coverage, that remains unchanged. You don't need to get a new insurance policy and register it with RICO. Like that remains unchanged. But what I'm saying is that there's still a legal advantage when it comes to having this corporation basically kept away from your personal assets. So let's just say, for example, you're self-employed. You make, let's say you had a really good year, you have a lot of cash from your commissions, and now you're thinking, okay, I'll just put it like in some personal investments or whatever, or RSPs. Well, the issue is that you still technically run a risk of legal issues, because even if you technically your errors and omissions, liability is unchanged, you could still get sued for anything personal nowadays, whether, you like, God forbid, you get into a car accident, or or let's just say you even go, say, I mean, this is like a pre-COVID discussion, but let's say you go to a restaurant, you don't like the food, you give a bad review, and now the owner's now suing you for like damages. Something ridiculous, but hey, it happens, right? So you got to keep in mind when these personal legal issues come up, technically creditors would have access to all your personal assets, right? So what I'm saying here is that if you have your personal real estate corporation, which, housing a lot of the cash and some of your investments as well, technically technically the creditors wouldn't, or they have a lot more limited access to get access to those funds. So just something to keep in mind there, right? And the other thing too is that if you're considering saying, okay, well, I have all these personal assets now, I want to move them into my corporation or my PREC, you got to be careful about that. I mean, it's like, especially if you're talking about rental properties, you may have a land transfer tax issue when you're doing this. But more importantly, in general, it's important to at least review the lender covenants to ensure whether moving these assets are actually permitted, right? And as I was just saying, the PREC does not change your exposure to errors and omissions risks. Other regulation requirements. So this is like, we've already kind of gone over a lot of them already, but there's a couple other requirements that the regulations do say when you're operating your PREC. So as soon as you open up your personal real estate corporation, the regulations do say that you need to have a written agreement between yourself, being the shareholder of your PREC, the PREC itself, and the brokerage. So I'm sure there's a lot of brokers out there. I'm sure Zolo, I'm sure that they may already have like a template of one in place. If not, we can offer guidance on that. But basically, there's a couple things that need to be in this agreement. Firstly, being the PREC cannot hinder or obstruct the brokerage or broker of record from performing their duties under the Act, and vice versa. Similarly noted, the PREC must provide reasonable assistance to enable the brokers to comply with their duties under the Act, and vice versa. What's also important in the agreement is that it should state how the payment of commissions earned by the realtor will go to the PREC, right? So, as it is right now, when you get paid commissions, it goes to you individually. When you have a personal real estate corporation, those checks need to be under the personal real estate corporation's name. Otherwise, you cannot deposit it into your personal real estate corporation account, obviously. And lastly being, you must have a formal acknowledgement regarding the PREC's exemption from registration. So it is, again, a very boilerplate thing, but it's something that the regulations do require. So make sure you get that sorted out when you set up your personal real estate corporation. Some other things as well, the PREC must be incorporated under the Ontario Business Corporations Act. So what does that basically mean? If you want to get, let's say you look online and you think, oh, geez, I can save $20 by, setting up a Canada Corp versus an Ontario Corp, do not set up a Canada Inc. Corp. It must be an Ontario Inc. Corp. And you may be wondering, saying, well, can I use a numbered corp? That's totally fine. In fact, some lawyers would even say, for legal reasons, it's better to have a numbered corp, so that way it's harder for creditors to look you up, stuff like that. So You can definitely do a numbered corp, totally fine. Also, a PREC cannot be a brokerage and vice versa. So if you have, let's say you're running a sub brokerage, you want to set up as a PREC, unfortunately, you cannot have it as PREC. Not that I'd see why you'd want to do that, but that's technically something that they also say. And also, you must, as soon as you set up your PREC, along with having the new agreement, you must notify RICO of the legal name of the PREC and its registered address. So they make it quite simple. They're just asking you to say, or they're just telling you, saying, write an email to us, giving us this information, and we'll keep it on file. Now, when these regulations came out, RICO gave interpretations of some things, because anytime you're talking about law, some things are kind of gray. So RICO did take the position on a couple things, which is important when we're giving advice to our clients to say what you can do. So the one question that comes up often is groups and teams. So, we've gotten this question a lot ourselves, even on Realty Tax. A lot of realtors work in teams, and they say, well, if I have, let's say, 3 people on my team, can I just set up a PREC, have them all, let's say, 30% shareholders, or in this case, if it's 3 people, it'd be 33% shareholders, and that's it, and we can just split, the commissions that way? Technically, no. The regulation's saying that you can only have one single shareholder who's a registered broker or salesperson. So basically 1 agent per PREC. Now, that doesn't mean you got to break away from your team. What that basically means is that when the brokerage is paying commissions to each of your team members, they can, if they're interested in tax deferral and all the other advantages we talked about, you can still set up a PREC, but you can't have your team as 1 PREC. Also, regarding advertising, as I was saying before at the beginning, the public cannot be made aware that the PREC trades in real estate. So what that basically means is that you cannot advertise saying like, oh, I'm John Smith PREC, or my PREC number is whatever, like you're not allowed to do that, which for most realtors, they probably don't even care about advertising that, but some may want to for the advantage of having a corporation. Don't do that. So as I was saying, you cannot advertise using the name of the PREC. But what's also interesting is that there isn't any naming restrictions that appear to exist, other than, let's say, naming restrictions that exist under the Ontario Business Corporations Act. So if you're saying, well, if I want to name it like my PREC name, if I want it to be John Smith PREC or have a numbered company, no issue there. But obviously you got to meet the Ontario laws too. So a couple other things here. Some of them I've already discussed. Some people say, well, I already have a corporation that I kind of ran for some other side business that didn't really go anywhere. Do I really have to set up another corporation again? Technically, and this is one advantage, the answer is no. You don't have to set up a brand new corporation. Like Rico says, you don't have to, set up like a new company. You can use what you have, that's fine. But you got to be careful about this, because you must ensure that old corporation meets the attributes that these regulations are requiring. So if, right now, if you have, let's say you have you and your brother as controlling shareholders of your corporation, that technically is against the regulations. And we got to keep in mind, if you are against the regulations, what's the risk here? The risk is that you'll be forced to basically register as a brokerage, which has a ton of other problems. So if you're trying to be on side with the regulations here and not deal with a bunch of crap from RICO, you basically want to be careful about this. So make sure before you're starting any old corporation that it does meet the corporate attributes, right? Also, regarding professional liability insurance, I discussed this before. The PREC is not covered under RICO's liability insurance. So what that basically means is that the PREC is not registered for errors and omissions liability. And what that also means is that the insurance coverage that you already have remains unaffected. So you don't, as I said, you don't have to go revise your insurance policies. Also, RICO clarified that you do not need to have a trust account. So as brokerages, or if you're running a sub brokerage, you may have you should be having a trust account. PRECs do not need to have that, nor are they allowed to hold any deposits in trust. Do you want to discuss other things to keep in mind?
Yeah, sure. So the way this works, when you incorporate a personal real estate corporation, what will happen is once you have the articles of incorporation, the CRA, Canada Revenue Agency, our best friends, right? They will automatically mail you a business number. So that's you right now you all have these HST numbers, which is 9 digits followed by RT0001. So that HST number, you'll eventually close it down once you file the final HST return, and the CRA will mail you a new business number for your new corporation. And under that business number, you can open the new HST number, which is the same number as the business number they mail you, followed by RT0001. Okay, so with HST, nothing really changes. Your brokerage pays the commission to your personal real estate corporation, and you collect HST. So your personal real estate corporation receives the commission plus HST, and you should set the HST aside, and your corporation will file HST returns. Nothing really changes here. It's basically the same. And keep in mind also tax installments. For those of you, most realtors pay HST in installments and personal tax installments, right? The rule is if you owe $3,000 or more of tax in a year, then the next year you have to pay in installments. The CRA does not have any patience. They don't want to wait for their money. Okay. They want their money. So you got to pay it throughout the year. And that's the same thing with corporate income tax and HST on the corporate level. It's the same principles apply. So very important what Steven and I recommend to all our clients. Now, whether our clients listen to us, that's a whole other story. That's why I became the grumpy accountant. No one listens to me. But what we really try to get people to do, we really try to force our clients to do, when you open the new corporation, you open a checking account, right? You're going to go to the bank, take the articles, they'll open a corporate bank account for you, a checking account. And at no extra cost, you tell them, I'd also like to open a savings account. And then every time you get a check or a deposit into your corporation for commission income, take the HST portion and just set it aside and just put it into that savings account. And that way you'll never have the problem. And you should be doing this whether you have a corporation, whether you're self-employed, like right now, if you haven't incorporated, you should always set aside the HST and maybe even more, 10% more, 15% more for personal income tax as well. And that way, at the end of the year, or when it comes time to make HST and tax installments, you'll never fall behind. You're ahead of the game. I know this is difficult for people, but it's really important that people do this so they don't fall behind on their tax payments. So what we do, what we're offering, this is one of the questions in the chat, but we're basically all-in-one solution. So we're doing everything, whether you have a Prac, whether you don't have a Prac. So whether if you're staying as self-employed and you don't need to incorporate, we can also offer a service to you. The one thing we do that most accounting firms, obviously, they file your tax returns, which we obviously do, your corporate tax return, personal tax return, HST returns, T4, T5, right? Salary, dividend, you got to do a T4 for salary, T5 for dividends. So we do that. But the nice thing that we also do, and we insist on doing this, is we also take care of your bookkeeping on a monthly basis, because we really don't like the spreadsheet method. I'm willing to bet that most of you here today probably wait until the end of the year. You have a pile of receipts in the shoebox, and then you take an Excel spreadsheet like it's 1997 and you manually add receipts into a spreadsheet. We hate that method. We put everyone in different apps that we like, online cloud-based apps like QuickBooks Online and Receipt Bank. And we have a really seamless system where we update your books every single month, whether you're self-employed or you have the corporation. Either way, we can offer a bookkeeping service to you. And I'll let Steven continue actually the rest of this part.
Yeah, and I was going to say, I think for our firm, what I think, because I mean, I'm sure a lot of you already have your own accountants, which is totally fine. I mean, we understand we're not the only accountants in town. But what I would just say though is we are right now the only firm that deals exclusively with realtors. And I think from a business owner standpoint, it's a great advantage. I mean, as a business owner, let's say being a realtor, I mean, it's a great advantage because it's a tailored approach. I think anytime you have a specialist, it helps with navigating through a lot of the unknowns, understanding the regulations, having a contact with recall, even just speaking to other realtors, we get a very good understanding of what the requirements are, how you're supposed to kind of, run this PREC, what's most optimal. So I think, again, not to discredit any other CPA firms out there or other bookkeepers or tax practices, whatever, but I think that our advantage is that we are tailored specifically for realtors. As Neil was saying, we encompass all the services that you'll need. Also, our firm is 100% online based. So it's funny because Zolo is technically like an online brokerage. We are also an online firm as well. So our firm is 100% online based. No in-person meetings are required, especially during COVID. Not that we don't like meeting people, but during COVID, we know that like it's challenging to meet people. So we respect that, and we have it fully online based, using obviously secure methods to transfer personal information. Also, all our fees are agreed up front and paid monthly automatically. So, I mean, this is an issue where I have with previous clients where they sometimes get, let's say you do work and then you present them a bill and then they're like, oh, why am I paying so much? I didn't see this coming. Well, with our firm, because we know the amount of work that will be needed, it's a fixed rate. So it is charged monthly, but you don't have to worry about these surprise bills that come up. And I was, as Jane even said at the beginning of the webinar, feel free to check out our website. There's a lot of information on there. There's a lot of good articles. So we actually have every week we've been posting a new article talking about something that is tax related for realtors. So there's a whole bunch there. Feel free to check that out. And to get added to our mailing list, there's a little subscribe button on our page. Check that out. Also worth noting is we actually updated our Incorporation Calculator. So this basically just shows, in the first year, how much tax would you defer? We'll call it like year one. I actually was updating that yesterday for the 2020 tax rate. So it is brand new. Feel free to check that out and yeah, have fun with that. So regarding the next steps, because I'm sure some of you may be wondering, saying, okay, you know what? I really want to set up this PREC. I want to do it as soon as possible. But obviously, as I was saying, you want to speak to an advisor before you make any decision like this. So we highly recommend reach out to us. Our emails are below. We also have a phone number where it's on our website, which it will get redirected. Don't try calling right now because we're on the webinar, but basically, yeah, you can reach out to us through various means to have a complimentary discovery session. So sometimes people will say, well, is it really worth it for me? How much tax will I save? How much will the admin fees be? All that kind of stuff. We can answer that in the call. Also, as I said, subscribe to our website to get updated information. Also, if you haven't had a discussion with your brokerage already, like with with the broker of record at Zolo or whoever's managing that, make sure you do speak to them before you actually get a new agreement in place, making sure everything's okay. And also worth noting is we have begun the actual process of incorporating PREC. So, I mean, as much as it is a new law, there's quite a few realtors that we're already serving. So again, it gives us that ability to really serve you and give you that nice tailored approach. So we're going to get into, I know there's a lot of people that ask questions, and we'll be happy to answer them. I just want to discuss the first three main questions that we often get. So the first one is asking, that we often get asked is, can my PREC claim commissions on deals that closed before it was formed? Unfortunately, the answer is no. So technically the PREC must be formed and deals must have closed before the PREC can claim that as income. So basically, and the other reason why we're talking about the deals that closed is that the closing date is basically the point in time when the brokerage now owes the realtor the commissions. That basically means that, when you're talking about accounting, what is when is that commission earned? Really, it's based on closing date. That's from not only from what we know, but even from what our lawyers have mentioned as well on various occasions. So just want to bring that up. Second question, can you set up your, can we set up the PREC with all the necessary documentation? So the answer is yes. Now, us ourselves, because we're CPAs, we don't actually prepare that incorporation documentation, but we work very closely with a third-party law firm that does do incorporation. So, their fees are very reasonable. They give you basically everything you need. And it's worth noting too, because a lot of realtors may say, well, you know what, I want to save on cost. I don't want to get the whole minute book. Can I just get my articles and pay these other websites to just do it? You technically can, but you got to be careful about this because again, the PREC is governed by regulations that states who the primary shareholders are, or who, or yeah. So basically saying, who, yeah. I mean, as I was saying, like, if the realtor is only, if there's a condition that says only the realtor needs to be the shareholder. And the issue is that if you just have incorporation documents to simply just to say like your articles of incorporation, that doesn't state who the actual shareholders are. So it's important to actually get what we call the minute book. With the law firm that we deal with, they actually provide a digital minute book. So that's good for you. It's all totally fine. And the third question that we often get asked is, how much do you charge? I want to know like your flat rate and whatever. So unfortunately, because each realtor is different, depending on the number of transactions, depending on if it's necessary to have a holding company, we don't like to just say, hey, our rate is this for everybody. But what I would say though, is that our rates are very reasonable and competitive with other firms out there. We do have fixed monthly billing, as I was saying earlier. And as I said, if you really want to get to some numbers, reach out to us for a complimentary consultation and we'll be happy to give you a quote. Okay, so I chatted a bit. I'm sure there's a lot of questions here. So I don't know, Neil, if you want to start with them.
Sure. So what kind of expenses can we write off in the Prac? So I answered that. I just wanted to reiterate it. All the expenses that you're allowed to claim now, as your, if you're self-employed sole proprietor on your personal tax return, on that T2125 statement that people love, basically it's all the same. Like on the corporate level, you're allowed to claim home office, your car expenses, all your dues to RICO and OREA, all of these, it's basically all the same expenses. So you're not losing out by having a Prac in terms of missing out on any expenses. And also for vehicle expenses, I posted a link to an article I wrote on our website. We write an article at least once a week on our website. So car expenses, it's similar also to how you're doing it now. You're allowed to write off, a percentage of your gas and insurance and repairs and 407 bills and your parking and your license renewal fees, all of these expenses. You should actually track the kilometers you drive for business use and compared to your total kilometers driven during the year, and you claim a percentage. So some realtors have called us and said, I claim 100% of my car expenses. And we always tell people, don't claim 100%. If the CRA audited that, they would not like that. So, you claim 90% if at the most, right?
I just also commented that too. It depends on how many vehicles you have. Like if you'll say you have one vehicle that's strictly used for business, you have another vehicle that's used for weekends and ball games or whatever, then okay, you can definitely claim a higher percentage, right? But if you only have one vehicle, then it's going to be harder to say, yeah, even 90%, right? So you got to be careful about these percentages that we're talking about.
Yeah. So someone asked about the loan, the CEBA loan, 60,000 loan. It was 40,000. They increased it to 60,000. The Bank of Canada is just printing money for everyone. So the tax issue about these loans, so you have to be careful. First of all, the forgivable portion of the loan. So I think now that's 60,000. I think 20,000 of it is forgivable, if I'm not mistaken. That actually becomes taxable income in the year you receive the loan. So if you got that 60,000 in 2021, for example, you have to add $20,000 to your income and pay tax on that in 2021. So you got to be careful. The other thing to keep in mind with these government loans, this CEBA loan is brand new. It's actually being administered in partnership with the banks. It's a weird thing. It's not, we have no idea how the CRA is going to audit these loans, because the rule is you have to use the loan for your normal operating expenses. You can't just take the money and invest it and start earning dividend income. That's not how it works. So you have to be very careful and have really good documentation for your expenses that you're using the loan for. So I would really read the fine print. I know people can apply online, right through their online bank account for these CEBA loans. But I'm telling you, people are just clicking accept and they're not reading the conditions, and it's going to cause problems later on. So I would just say, like, you got to read those terms and conditions carefully before agreeing to it.
I was gonna say, I think we have a question here about, could you buy your vehicle under your Prac? I don't think we answered that yet, did we? No.
Right. So technically you can. Um, you can buy a vehicle under your Prac. You can also lease a vehicle under your Prac, right? So when you buy a car, you can claim a depreciation expense, but you'd have to record a personal use portion of the car. Because again, where nobody is 100% using their car for business use, maybe some people are, okay, but if you're only using it 90% for business use, then in your corporation, we would have to make an adjustment at the end of the year. It's something we would take care of to record that personal use. But technically, you can buy a car under your corporation. The insurance might be higher on your car insurance if you do that. So you got to watch out. There were a whole bunch of questions about our fees. How much do we charge? How much does it cost to set up the Prac? Again, we can have you guys, people can reach out to us individually. We could go through your situation, but our fees are very reasonable. I think you'll be surprised. It's not like $500 a month, or it's less than that. Okay. So, but we'd like to have the conversation one-on-one. In terms of setting up the Prac, we send you directly to a corporate lawyer that we're sending everyone to. They do amazing work. They're very fast and their fees are very reasonable. So if you wanted to try and incorporate a Prac yourself, you can. It has to be, as Steven mentioned this, it must be an Ontario corporation. And the Ontario government charges about $360, I think, or $360 to $400 to incorporate. That's a government fee. That's not a legal fee or anything. That's directly to the government. So technically, if you want to do it on your own, that's how much it would cost. It's a one-time fee. That's not annually. That's just one time. And then the lawyer adds, if you use a lawyer to do, they add a little bit to that. So, but the fees we have are very reasonable. The lawyers we work with are really good. They're fast and very reasonable.
And just actually another question that sometimes I'm just thinking about it now that we sometimes get asked too is that, well, there is that one-time fee for incorporation, but if you want to, technically a lot of lawyers say you got to update your minute books annually. Do you need to hire a lawyer for that? I would say for the most part, you really especially if it's like a simple setup, you really can almost, update the minute book yourself. I'm not trying to say that you should avoid a lawyer, but my point here is that you're not forced to retain a lawyer to update your minute books on a regular basis. And by updating minute books, it's just more like, saying, let's just say if we did a salary or a dividend, that should be recorded in the minute books, stuff like that.
Okay, we have two really good questions that just came in here. One of them is my favorite question. So I'll start with my non-favorite question. If you have a debit card and credit card, does it matter which you use for expenses? Okay, so technically, no. What we recommend is, like for us, from an accounting perspective, the ideal situation would be in your Prac, you have the bank account with a debit card, maybe you have a credit card. Okay, so what we recommend is you try very hard to put all your business expenses on that debit card and credit card in the business, and all your personal expenses on a different card. Keep it separate on a personal card. And then we do the bookkeeping for you in our system. We automatically, like QuickBooks Online, automatically gets the feed from your debit card and credit card, and we could record the activity and we would know everything is business. So you could use a debit card, you could use a credit card. It doesn't really matter which one you use. It's whatever you prefer. But the main thing is it makes the bookkeeping a lot easier and much more painless if you can separate out and have your business expenses on one card, your personal expenses on a different card. Now, if you only have one credit card and you like to put everything on it, that's okay too. We can still provide service to you. It's not a problem. But it's obviously better if you can separate it. Now, the other question was shareholder loans and buying a primary residence. Okay, so this is very tricky. The rule is with these corporations, your personal real estate corporation, when you take money out for personal use, and buying your primary residence is definitely personal use, okay? You have to show that withdrawal from the corporation as personal income, salary or dividend, T4, T5 income, and it goes into your personal income tax return and you pay personal tax. Now, when these corporations first came into play, like in the 1970s, people started to mess around. They would take money out and they would say, oh, it's not my salary, it's a loan. I'm just taking a loan from the corporation. I'll pay it back in 50 years. Don't worry. I don't have to pay tax on it because it's a loan. So the government got wise to this, right? And they made a rule. I think it's section 15.2 of the Income Tax Act or something. I don't know anyone who reads the Income Tax Act, but I think it's section 15-2, shareholder loan rules. When you withdraw money from the corporation as a shareholder loan, you must repay that money back into the corporation by, here's how it works. Let's say you take out the money today and your year end is December 31st. Okay, so you take out $1 million from your corporation on February 18th, 2021. Your year end is December 31st, 2021. You have until December 31st, 2022 to put the money back into your corporation. You get 1 year, 1 fiscal year, where you're allowed to keep the money as a loan, okay? And if you don't pay it back by December 31st, 2022, that becomes personal income to you. You have to show that as income and pay tax on it. So you got to be very, very careful whenever you take out money from a corporation. We have to deal with that as salary or dividend somehow. And that's why we love doing the bookkeeping monthly for our clients, especially who have the corporation, because that way we can see every month as you're taking out money, we can be on top of you and remind you, okay, what's our plan here, salary, dividend. And we do this tax plan at least once a year, if not more, with our clients. We determine, okay, how much money do you need this year? Do you need $5,000 a month? Okay, we'll set you up on a salary and we'll calculate that all for you. So principal residence, you can't really buy on your corporate level, and you wouldn't want to anyways, because obviously when you sell your principal residence, tax-free capital gain, so you have to declare that personally. You can't, it doesn't make sense that your corporation would own a principal residence. You can't really do that. I think we have an article up on our website I wrote about, will the government possibly start taxing the sales of our principal residences because they're desperate for money? I wrote a whole article about it, and I compared to actually in the US, they do tax the sale of a principal residence, but in the US, you're allowed to deduct mortgage interest and there's a big exemption amount. So there's a lot to discuss here, but basically the answer to your question, shareholder loan to buy a personal use property, principal residence, you have to repay the money by the end of the next fiscal year if you want to do something like that. All right.
Wow, awesome, you guys. Thank you so much for answering all of the questions. I know you stayed on top of the chat box as questions were coming in, so thanks for that, Neil. Both of you, super, super informative. Clearly, as somebody mentioned in the comments, you guys are experts in this field. So I do encourage you guys who are listening now or listening to the recording to reach out to them, REALTYTAX.CA. You can see their email addresses there as well. Definitely, if you're thinking about registering as a Prac, then definitely reach out to these guys. And thank you so much for joining me. I'm going to have to thank Ronnie as well for introducing you to Zolo. And I hope that, yeah, that you get lots of calls, and yeah, you guys definitely know, yeah, what a wonderful presentation, getting comments on that. So thanks again for joining me today. We have a couple of minutes left. If there are any last minute questions, I'll throw them your way, but otherwise I'll let you go for lunch.
Yeah, and again, I was gonna say thank you all for joining. I mean, I think it was over 70 on the live. I'm not sure if you see the same thing on your end, Jane, but it's a huge turnout. So it's amazing.
Yeah, really good turnout. So yeah, I'll send you the final numbers as soon as we wrap up. I'll send you an email, and yeah, we should do this again. This was super informative. Thank you. I was actually registered as a Prac when I was a realtor back in Vancouver, but I didn't understand it as well as I do now. So
oh, interesting. Wow. Actually, it's interesting that you mentioned that, because that's one thing, even when we were starting too, was, maybe we should reach out to some realtors out in BC to see, hey, how did it work out there? But
yeah,
we discovered that the regulations there are almost like, I don't want to say it's totally different, but there is some pretty big differences.
yeah. Well, the major one being the advertising in
yeah, they actually required you to have the name PREC in your name, which is,
yeah,
I guess for some people they like it, others are like, well, whatever.
yeah. Absolutely. Okay, so we do have a last minute question coming in. Yeah, definitely check out the book, grumpyaccountant.ca. I love that title. Lex has a last question coming in. Do you see that on the chat there?
Yes. Neil, did you want to take it, or?
Oh, where it's okay. The threshold where it's worth it to incorporate. Okay, so before I answer that, I also am going to post a link to my petition to Justin Trudeau to simplify the Canadian tax system. Okay, so anyone who wants to sign that. So, okay, is there a specific threshold where it's worth it to incorporate? That's a great question. Basically, the answer is you have to look at two different numbers, okay? Number one is your income. What's your income, your commission income, okay, after expenses? So let's say your profit from your commission income. And the next number is how much do you need to live off of personally? So if you were to tell me your commission profit is $1 million a year, but you need $1 million a year to live off of, like you have a very expensive lifestyle like Drake, and you live on the bridle path and you need $1 million a year. So it really wouldn't make sense to incorporate, because your corporate income would be $1 million. Your salary expense would be $1 million. The corporate profit would be zero, and you'd pay $500,000 of income tax on the $1 million salary. Okay. So, but if you were to tell me, let's say a more realistic example, your income is $200,000, but you only need $100,000 for personal living, at that point, it would be worth it to incorporate, because that extra 100,000 each year that you don't need for personal use, you could leave in the corporation. So that's basically what you have to figure out. Are you making more money than you need for your personal use? If so, it might be worth it to incorporate. That's kind of how you look at it. Now, yeah, go ahead.
Sorry to interrupt you, Neil. I was just going to say, I mean, you also got to look at, sometimes people say, well, I'm only making, say, 50,000 commissions. I just started out, or I'm just doing this part-time as a realtor. Maybe I don't need this. But if you have another full-time job and you're using that full-time job to support your living expenses and travel and leisure and whatever, right? Maybe not travel these days, but, maybe hopefully next year. Basically, yeah, I mean, you still have a situation where, that income you're earning in your realty activities can be saved up. And when you have the ability to save it all up, that's when you get tax deferral, having that personal real estate corporation. So, and I know sometimes people say, well, even here it's being asked basically 90 to 100. Well, again, is that your only source of income? And also, how much are you drawing out, right? Do you have other, if you have a full-time job, and again, you only say making, even say 40 to 50,000, you're not touching that money. You can still benefit on tax deferral having a personal real estate corporation.
Yeah. And also the other way to look at it is, if you're someone who really likes to max out your RSP contribution each year, so in order to do that, you would have to pay yourself a salary of approximately $154,000 a year. So if your income every year was $150,000, maybe in that case, it wouldn't make sense to incorporate, because you would declare the entire amount of income as your salary and make a big max RSP contribution each year. So that's something to consider as well. But if your income is, but RSPs aren't for everyone. It depends really on your situation. So it might not be for everyone, right? You might prefer TFSA or a combination of, so if your income is above 150, basically anyone whose income is above 150, most likely, probably 100%, it is beneficial to incorporate. But that's not to say that if your income is below 150, it wouldn't be beneficial. It really might be. So you can get in touch with us, and we do complimentary consultations, and we could talk about your specific situation and give you that specific advice.
Yeah, I just also say too, I mean, I said it a few minutes ago, we do have that incorporation calculator as well. Again, it's not elaborate by any means, but just to get like a basic idea of saying how much tax can I defer in, let's say, year one, if I have, let's say, another job, you can put the numbers in and check that out. And again, also because we don't technically save that data, if you wanted to, save that page of the results as a PDF, you can discuss it with us as well, or we can just go through the numbers in more detail.
Awesome. Thanks so much, you guys, for joining me today. Great interaction from those who were on the call today. And as I said, we'll have to do this again. Super, super informative. So yeah, reach out to REALTYTAX.CA. Steven, Neal, thanks again for joining me. And we'll see you soon, I hope.
Thank you very much. Thanks so much.
Have a good day.
You too.